Are we on the verge of a massive market shakeup? While some analysts are calling for a September drop, others believe the bull run is only just getting warmed up. Cowen sees Ethereum making a run for a new all-time high before pulling the entire market down. But institutions like BlackRock are thinking differently, snapping up Ethereum 15 times faster than they did Bitcoin. And the US government might be the biggest whale of all. Crypto Casey reveals a new executive order for the Treasury to create a strategic Bitcoin reserve. With George from CryptosRus seeing a massive supply squeeze on Bitcoin, and Lark Davis saying to forget the old 4-year cycles, who should you believe? The experts are divided, and it looks like a major move is coming soon. In the latest video from Altcoin Daily, the discussion kicks off with a bold prediction about Bitcoin's future. Macro investor Preston PYSH explains that people who plan to sell Bitcoin at $1 million just don't get the bigger picture. He suggests that if Bitcoin hits $1 million, it's on its way to $10 million or even $100 million because its value isn't just about growth, but about the devaluation of traditional fiat currencies. The video argues that we're still in the middle of Bitcoin's adoption S-curve, so the idea of diminishing returns doesn't really apply yet. It's interesting how the conversation is shifting. For years, it's been all about Bitcoin versus everything else. Now, the narrative is getting more layered. The point about real-world asset, RWA tokenization feels especially timely. We're already seeing major players like BlackRock launch tokenized funds on public blockchains, which seemed like a pipe dream just a couple of years ago. The video's focus on Ondo and Chainlink fits right into this trend. While everyone is watching Bitcoin's price, the quiet background work of tokenizing trillions of dollars in real-world assets might be the story that defines the next decade for this technology. It feels less like a speculative bet and more like a fundamental upgrade to financial plumbing. In the latest video from CryptoRover, he explains why he's doubling down on his positions while many traders are feeling uncertain. His whole strategy is based on a simple idea: follow the whales. He points out that while retail investors are selling off their Ethereum, big institutions like BlackRock are buying it up at an incredible rate. To put it in perspective, BlackRock has been accumulating Ethereum 15 times faster than they did Bitcoin over the last 30 days, and they already own 750,000 Bitcoin. These financial giants are reportedly raising another $20 billion just to buy more Ethereum. This tells him that smart money is absorbing all the selling pressure from smaller investors. He's holding his trades on Ethereum, Arbitrum, Aptos, and DAO, expecting a big move up. His price target for Ethereum is $6.5 thousand, and he sees Arbitrum potentially hitting $1. He also notes that Bitcoin is currently holding a very important support level. If it breaks, we could see a big drop, but for now, the trend is still up. With major economic events like the FOMC minutes and a speech from Jerome Powell next week, he believes it's a bad time to bet against the market. It's interesting to see the focus shift so heavily onto the smart money narrative for Ethereum. This isn't just random talk. The recent approval of spot Ether ETFs in the US has genuinely opened the floodgates for institutional capital. The video's point about BlackRock's aggressive accumulation lines up perfectly with the broader market story. While the price of ETH hasn't exploded just yet, it feels like a lot of foundational work is being done behind the scenes. This disconnect between retail sentiment, which seems a bit shaky, and institutional action is pretty stark. It suggests that large firms are playing a much longer game, using the current market chop as their entry point before the mainstream crowd catches on. In the latest video from Lark Davis, he argues that the crypto bull market is far from over. In fact, it might just be starting. He suggests we forget the old 4-year cycle timing. The reason? A perfect storm of a new bull market in traditional finance and a fundamental shift in crypto structure. Wall Street is getting bullish, with analysts like Morgan Stanley's Mike Wilson calling the end of a 3-year recession and setting S&P 500 targets as high as 7,200. This positive feeling is spilling into crypto. It's hard to argue with the point that the market's DNA has changed. The introduction of spot ETFs was a massive structural shift, and the steady institutional money is a clear stabilizing force that wasn't there in past cycles. The slow grind up he describes feels very real. We're seeing less of the chaotic face-melting volatility and more deliberate, measured moves tied to the broader economy. This connection to traditional markets is a double-edged sword, though. While it brings in a ton of new capital, it also means crypto is more sensitive to things like Federal Reserve interest rate decisions and inflation reports. The idea of a massive altcoin run makes sense, but it might unfold more slowly and methodically than the explosive seasons of the past. The market has matured, and the wild, untamed days may be giving way to a more predictable institution-led era. In the latest video from the Ben Cowen channel, he talks about Bitcoin's recent move to a new all-time high of around $124,000 and the rejection that followed. He finds that the current market pattern doesn't feel like 2017 or 2021, but instead looks uncannily similar to 2020. He points out a strange coincidence. The peak price in a mid-August 2020 wick was about $12.4 thousand, and our recent high was exactly 10 times that at $124,000. Ben speculates that before Bitcoin sees its typical September drop to the 20-week moving average, something else needs to happen first. He believes Ethereum is currently pulling liquidity from the altcoin market to fuel a rally to a new all-time high. His predicted sequence of events is that Ethereum will make its run in the next few weeks, and right after it hits a new peak, the entire market will pull back, with Bitcoin leading the drop down to its 20-week support band in September. Ben's theory about Ethereum acting as the final catalyst before a market-wide correction feels quite plausible. There's a lot of chatter about the potential for Ethereum ETFs to get a final green light, and that anticipation could be exactly the fuel needed for one last leg up. It fits the classic buy the rumor, sell the news scenario. If Ethereum hits a new all-time high on that excitement, it would be a perfect spot for profit-taking, which could trigger the broader cooldown he's predicting for September. The fact that many altcoins are struggling against both Bitcoin and Ethereum right now seems to support his idea that liquidity is being concentrated for a big move. The market does feel like it's holding its breath, waiting for the next major narrative to play out. In the latest video from Coin Bureau channel, Nick breaks down how to spot the top of the crypto market so you can walk away with solid gains. The main idea is that Bitcoin leads the way, and historical patterns suggest it will likely peak sometime between September and November 2025. The final push to the top is usually triggered by a massive piece of good news that makes everyone feel like the price can only go up forever. This time, that trigger could be a government, like the Czech National Bank, announcing it has bought Bitcoin. The video presents a really logical framework for thinking about the next market top. Basing predictions on historical cycles and identifying potential euphoric news events makes a lot of sense. The timeline of late 2025 aligns with what many analysts are considering. The point about psychological price levels like $150,000 for Bitcoin is especially sharp. We've seen this play out before where the market turns just before or after a widely anticipated target. However, this cycle has a new variable that wasn't as present before, the US spot Bitcoin ETFs. The consistent, heavy flow of institutional money could potentially alter the traditional cycle length or intensity. While the video's historical approach is a great guide, the market might behave a bit differently this time because of this new and powerful source of demand. In the latest video from CryptosRus channel, George answers a couple of really timely questions from his audience. First, he tackles a theory about Bitcoin's growing scarcity. He totally agrees that Bitcoin is getting harder to find. With a hard cap of 21 million coins and estimates that 4 to 10 million are already lost for good, the available supply is shrinking fast. He points to the massive buying from ETFs, which have snapped up over 1 million Bitcoin, plus constant purchases from companies and whales. This demand, he says, is why the price recently shot up to $124,000. For the long haul, he thinks Bitcoin will be worth well over $1 million in the next 10 to 20 years. Because of this, he thinks it's a smart move to roll profits from altcoins into Bitcoin, especially when the market gets super hot, which he expects will happen in late November or December. George's perspective on Bitcoin's long-term value due to supply shock is a core belief for many in the crypto world, and it's hard to argue with the logic. The constant demand from institutions is a new factor this cycle that really changes the game. His take on the altcoin market, however, brings up an interesting point. The feeling that gains are harder to come by is real for many. While he blames market makers, it also seems like the market is just more mature and fragmented now. There's so much capital spread across thousands of projects, it makes it harder for everything to pump at once. The idea of a banana zone is exciting, but it might be more selective this time around, focusing on specific narratives rather than a blanket lift for all altcoins. The discussion about whether a crypto winter will even happen is also fascinating. A full-on 80% crash seems less likely with all the big money involved, but a prolonged, choppy sideways market could be the new version of a bear cycle. In the latest video from the Crypto Banter channel, the host explains how you can use a small amount of money, like $100, to control a much larger position, say $2,000, through a process called leverage trading. He compares it to swimming. It's risky only if you don't know what you're doing. The basic idea is you're borrowing money to amplify your trades. For example, if you use 10x leverage on $100, you're trading with $1,000. If Bitcoin goes up 5%, you make a 50% profit on your original $100. But there's a big catch. If the price goes down 10%, your entire $100 is wiped out in what's called a liquidation. This video does a really solid job of breaking down the mechanics of leverage trading in a way that's easy to follow. The distinction between isolated and cross-margin is especially important for anyone new to this. However, the psychological pressure of leverage trading is something that can't be overstated. Seeing your position swing wildly in value can lead to emotional decisions. The Fibonacci strategy is a well-known technique in trading circles, but it's more of an art than a science. Markets, especially in crypto, are known for their extreme volatility and can easily ignore these technical levels during major news events or shifts in sentiment. The guide is a great introduction to the how, but the real challenge is managing the risk and your own emotions when real money is on the line. In the latest video from Crypto Casey, she breaks down Bitcoin's recent price action, where it shot up to a new all-time high of over $123,000 before getting pushed back down to around $117,000. She calls this a prime buy-the-dip moment, reminding viewers that we're still in a bull market and will be unless Bitcoin closes the week under $14,000. The volatility is chalked up to big institutions trying to scoop up cheap Bitcoin and some less than ideal inflation numbers. Still, prediction market Polymarket gives a 67% chance of an interest rate cut next month, which would be good for the market. The biggest news is that the U.S. Treasury is set to create a strategic Bitcoin reserve using forfeited coins, following an executive order from President Trump. The plan is to acquire even more Bitcoin to position the United States as a global superpower in the space. The video explains that Trump's pro-crypto stance is partly influenced by his family's personal experiences with being debanked by major financial institutions. Casey also shares her own struggles with banks being hostile to her crypto business and making it a nightmare to get a mortgage. Finally, she covers the Genius Act, a new piece of legislation that lets stablecoins offer a yield, which has traditional bankers in a panic because it could pull huge amounts of money out of their system. The bottom line is that the entire financial world is slowly but surely moving on to the blockchain. The way politics is getting tangled up with cryptocurrency is pretty fascinating. The idea of a strategic Bitcoin reserve for the U.S. sounds like something from a sci-fi novel, but it shows how far the conversation has come. It's no longer just about individual investing. It's about national strategy. The debanking narrative, whether it's coming from the Trumps or everyday crypto users, is a powerful story that frames crypto as a necessary defense against the power of big banks. It's turning a technological choice into a political statement. This could speed up crypto adoption massively, but it also risks turning Bitcoin into a partisan issue, which might complicate its goal of being a neutral global asset. In the latest video from Crypto Wendy, she talks about a project that's mixing together some of the hottest trends in crypto right now: real-world assets, RWAs, DP, and AI. The project is called PinLink #Pin, and it's not just an idea, it's already live and building. The main thing they've created is a marketplace for what they call RWA tokenized DPIN. In simple terms, this lets you buy a small piece of real physical hardware like a powerful Bitcoin miner or a data center. This video does a great job of capturing why the RWA and DP narratives are getting so much attention. PinLink's approach of merging them with AI is definitely ambitious. It's one thing to have a great idea, but the execution is what matters. The fact that they're already integrating with established players like Pendle and BitTensor is a very smart move. It shows they understand they need to be part of the larger ecosystem to succeed, not just build their own little island. The idea of letting everyday people get a slice of the pie from industrial-scale Bitcoin mining is pretty compelling, especially since mining has become so difficult for individuals. The strong initial sales they saw suggest there's real demand for this kind of product. In the latest video from the Modern Investor, the discussion kicks off with the upcoming Ripple Swell Conference scheduled for October 22nd and 23rd. There's a lot of chatter because Maxwell Stein, a director of digital assets at BlackRock, is set to be a speaker. This has sent the rumor mill into overdrive, with many expecting a surprise announcement of a BlackRock XRP ETF. The host, however, finds this fixation a bit absurd. He points out that there are already more than 17 different applications for XRP ETFs waiting for the SEC's decision. He feels the community's obsession with getting a nod from BlackRock is like a distraction, especially when you consider that a company like BlackRock has probably been buying XRP for years anyway. My take is that the host is right to be frustrated with the community's laser focus on BlackRock's involvement with XRP. It often seems like the crypto space needs validation from these massive traditional finance players to feel legitimate. While a BlackRock ETF would certainly be significant, the fact that nearly 20 other firms are already lined up for an XRP product is the real story of institutional adoption. The BlackRock appearance at Swell feels more like a classic by the rumor event than a guaranteed bombshell. On the Ethereum front, the supply shock narrative is incredibly powerful. The data showing ETFs absorbing 7 times the daily issuance is staggering. This isn't just about buying, it's about cornering the market. With the mechanics of staking and the illiquid nature of ETF holdings, the amount of ETH available for the average person to buy is shrinking fast. This could create an explosive setup if retail demand ever comes back in a big way.